In the annals of modern business, few stories encapsulate the allure and peril of venture-backed ambition quite like WeWork. Once hailed as a revolutionary force transforming the very concept of work, it promised community and wellness wrapped in sleek, flexible office spaces. From a single co-working floor in Soho, New York, WeWork rapidly ascended to a staggering $47 billion valuation. Yet, this trajectory was not one of sustained triumph, but rather a dramatic flight fueled by speculative capital, culminating in an inevitable and spectacular crash. What began as a utopian vision ultimately unraveled into a cautionary tale of corporate excess and flawed foundations. At the heart of WeWork's early success was Adam Neumann, a charismatic co-founder whose salesmanship was legendary. He didn't just sell office space, he sold a lifestyle, a movement. Neumann envisioned WeWork as a global platform, an ecosystem extending beyond desks to include residential living with WeLive and even education through WeGrow. His compelling narrative captivated investors, painting a picture of a company transcending traditional real estate to become a transformational tech disruptor. This boundless optimism, however, often overshadowed the fundamental economics of the business he was building, setting the stage for future complexities. Fueled by immense venture capital, WeWork embarked on an aggressive global expansion strategy. The company scaled at an unprecedented pace, opening hundreds of locations across dozens of countries in just a few years. This rapid growth was paramount to its narrative as a tech company, justifying its inflated valuation by projecting a vast market share and network effect. By 2018, WeWork was not merely a New York phenomenon, it was a multinational behemoth with an astonishing footprint, continuously adding new cities and thousands of members. This relentless pursuit of scale, however, came at a significant cost, stretching operational capabilities and financial resources thin. The primary accelerant for WeWork's hypergrowth and astronomical valuation was SoftBank, specifically its Vision Fund, led by Masayoshi Son. Son, known for his big bets, poured billions into WeWork, seeing it as a crucial component of his interconnected tech empire. SoftBank's initial investments and subsequent rounds effectively validated WeWork's ambitious, often unproven, business model in the eyes of other investors. This capital injection allowed WeWork to continue its aggressive expansion without immediate pressure to achieve profitability, fostering a culture of growth at all costs and temporarily shielding its underlying financial vulnerabilities from closer scrutiny. At its zenith, WeWork achieved a private valuation of $47 billion in January 2019. This figure was not merely impressive, it was audacious, placing WeWork among the most valuable startups globally, far exceeding established real estate players. The valuation was predicated on its self-proclaimed status as a tech company, not a landlord, leveraging buzzwords like community-adjusted EBITDA to spin its narrative. This valuation, however, existed largely in a bubble, disconnected from traditional financial metrics like profitability or asset ownership. It was a testament to investor enthusiasm for disruptive narratives, rather than a reflection of sound financial fundamentals. WeWork's core business model was deceptively simple: lease properties long-term, then rent them out short-term to members. This arbitrage strategy, while offering flexibility to clients, created a fundamental mismatch in its liability structure. The company was locked into billions of dollars in long-term lease commitments, often spanning 15 years, while its revenue came from month-to-month or short-term memberships. This model was inherently risky, making WeWork extremely vulnerable to economic downturns or shifts in demand for office space. Essentially, it was taking on substantial real estate risk without the benefit of property ownership, a crucial distinction often obscured by its tech branding. Despite its sky-high valuation and rapid revenue growth, WeWork was a financial black hole, hemorrhaging cash at an alarming rate. Its operating costs consistently outstripped its income, primarily due to expensive long-term leases, aggressive expansion, and lavish spending. In the run-up to its planned IPO, the company revealed staggering losses. This negative cash flow was sustainable only as long as investors continued to pour capital into the company. The narrative of growth before profit started to wear thin when the scale of the losses became undeniable, exposing the fragility beneath the shiny surface. To fully grasp WeWork's precarious position, it's essential to compare its model to that of a traditional real estate investment trust, or REIT. A REIT owns its properties, generating stable, long-term income from its assets. WeWork, conversely, owned very few of its assets. Instead, it was effectively a middleman, creating a significant mismatch between its fixed, long-term liabilities and its flexible, short-term revenues. This distinction meant WeWork absorbed all the downside risk of a property owner without the asset appreciation or capital cushion, making it far more susceptible to market fluctuations and tenant vacancies than its traditional counterparts. Beyond the financial structure, WeWork was plagued by serious corporate governance issues, largely centered around Adam Neumann's control and self-dealing. Instances included Neumann personally owning properties and leasing them back to WeWork, or WeWork paying him nearly $6 million for trademarking the word "we." His lavish lifestyle, private jet, and significant personal loans from the company raised red flags about conflicts of interest and lack of fiduciary responsibility. These actions signaled a company where the founder's personal enrichment was intertwined, and often prioritized, over shareholder value, severely undermining investor confidence and trust. The moment of reckoning arrived with WeWork's S-1 filing, the mandatory prospectus for its initial public offering. Intended to showcase its strengths, it instead exposed the gaping holes in its business model and governance. The document revealed astronomical losses, confusing financial metrics, and alarming details about Neumann's self-dealings. Analysts and investors, finally seeing unvarnished details beyond the hype, recoiled. The S-1 became a public dissection, turning what should have been a triumphant launch into a catastrophic exposé. It triggered widespread skepticism about the company's valuation and the true viability of its operations. The backlash from the S-1 filing was swift and severe. Investor appetite vanished, and the once impenetrable $47 billion valuation began to crumble dramatically. Potential investors balked at the terms and the governance issues, forcing WeWork to slash its target valuation multiple times. Ultimately, the company had no choice but to withdraw its IPO in September 2019, unable to secure the necessary demand at even a fraction of its former valuation. This public humiliation marked a critical turning point, exposing the deep chasm between private market exuberance and public market realities. With the IPO in ruins and the company teetering on the brink, Adam Neumann's position became untenable. Investors, particularly SoftBank, moved to assert control. In a dramatic boardroom showdown in late September 2019, Neumann was forced to step down as CEO, ceding control of the company he founded. His ouster was part of a larger SoftBank rescue package, which included a substantial payout for his shares, a move that drew further criticism. While his charismatic vision built WeWork, his questionable leadership and financial improprieties ultimately led to his downfall and the company's near collapse, proving that even the most compelling narrative cannot overcome fundamental business flaws. Following Neumann's departure and the failed IPO, WeWork faced imminent bankruptcy. SoftBank, already heavily invested, had little choice but to step in with a colossal rescue package, transforming its investment from an equity stake into a majority ownership. This deal, valued at approximately $9.5 billion, injected desperately needed capital while effectively buying out Neumann's shares for a significant sum, estimated at around $1 billion. For SoftBank, this was less an investment and more a damage control operation, aimed at salvaging its prior multi-billion-dollar bet and preventing a complete write-off. The bailout underlined the depth of WeWork's financial distress and SoftBank's commitment, however reluctant, to its survival. Under new leadership, WeWork immediately initiated a drastic restructuring effort. The priority shifted from hypergrowth to achieving profitability and financial stability. This involved massive layoffs, shedding thousands of employees globally, and divesting non-core businesses like WeLive and WeGrow. The company also embarked on renegotiating onerous leases and shutting down unprofitable locations. The focus was squarely on cutting costs, improving occupancy rates, and streamlining operations. While these measures were painful, they were deemed essential to right-size the company and move it away from its cash-burning ways, aiming for a leaner, more sustainable future. Just as WeWork began its arduous journey toward recovery, the COVID-19 pandemic struck, delivering a devastating blow to its already fragile business model. The global shift to remote work emptied office buildings worldwide, including WeWork's, virtually overnight. Demand for flexible office space plummeted, and existing members re-evaluated their needs. The pandemic didn't create WeWork's problems, but it dramatically accelerated them, exposing the inherent vulnerability of a business built on long-term lease commitments and short-term, fluctuating memberships. What was a challenging situation became an existential crisis, pushing the company closer to the brink. The impact of the pandemic on WeWork's core metric, occupancy rates, was catastrophic. Prior to COVID-19, the company aimed for high 80s or 90s% occupancy to cover its lease costs. Post-pandemic, these figures plummeted significantly as companies downsized their physical footprints or shifted entirely to remote models. With fewer members occupying desks, WeWork's revenue streams dried up, while its fixed long-term lease obligations remained. This created an insurmountable financial imbalance, exacerbating its cash burn and making the path to profitability seem increasingly elusive. The empty seats became a stark visual representation of its deepening woes. Even after extensive restructuring and SoftBank's massive bailout, WeWork continued to struggle with profitability. Years of aggressive expansion had left it with an unwieldy portfolio of expensive leases, many in prime urban locations that were now less desirable. The company repeatedly pushed back its profitability targets, a clear sign of ongoing operational challenges. Furthermore, legal battles emerged, including disputes with landlords and shareholders. Despite new leadership and a more conservative approach, the sheer scale of its pre-existing financial commitments and a changed market environment proved incredibly difficult to overcome, leading to further uncertainty about its long-term viability. The inevitable arrived in November 2023 when WeWork filed for Chapter 11 bankruptcy protection. This filing, while aimed at reorganizing its finances and shedding unprofitable leases, marked the formal end of its journey as a high-flying tech disruptor. It was a stark admission that years of restructuring, new leadership, and billions in bailout funds were ultimately insufficient to overcome its fundamental flaws and the seismic shifts in the global workspace. The bankruptcy allowed WeWork to terminate leases, exit markets, and reduce its debt burden, aiming to emerge as a much smaller, more sustainable company, but undeniably, a shadow of its former grandiose self. The decline of WeWork offers critical lessons for investors, entrepreneurs, and the broader tech industry. Firstly, it highlights the dangers of irrational exuberance and prioritizing growth at all costs over fundamental profitability. A captivating narrative and charismatic founder cannot indefinitely mask a flawed business model. Secondly, it underscores the importance of robust corporate governance. Adam Neumann's conflicts of interest and unchecked power were major contributing factors to the company's downfall. Finally, it reminds us that while disruption is valuable, core business principles like positive cash flow and sustainable margins ultimately dictate long-term success, especially when market conditions shift dramatically. WeWork's story is a complex tapestry woven with threads of innovation, ambition, and ultimate failure. While it popularized flexible workspaces and redefined office culture for a generation, its spectacular collapse serves as a potent cautionary tale against the intoxicating allure of hypergrowth without substance. It exposed the pitfalls of unchecked founder power, the fragility of a business built on precarious financial engineering, and the critical importance of a sound balance sheet. The company may re-emerge from bankruptcy in a more modest form, but its legacy will forever be etched in history as one of the most prominent examples of how a $47 billion dream can unravel into a multi-billion-dollar nightmare.